This podcast is intended and contains general information on financial strategies, investments, and products only. Whilst Luke and I are both licensed financial advisors, we don't know your personal circumstances, goals, or objectives. We highly recommend that you reach out to your financial advisor or investment professional to discuss any of the topics that we've covered today before taking any action. Our full disclosure, copies of our financial services guide, and additional information about Seneca Financial Solutions and Bold Wealth can be found in the show notes.
Hello and welcome to another episode of Wealth and Toil. My name's Luke Laretive and I'm here today with the man, the mystery, the mustache, Dylan Pargiter-Green. DPG, how are you, mate?
Mate, I'm really good. We spent most of last week, or I spent most of last week traveling. So back and forth between Melbourne, or all around Melbourne, I should say. So recording early the following week to apologise to all those people that missed us last week. We are trying to be more regular.
It's a shame. It's a shame we've both got jobs. It's it'd be
yeah,
great.
I know. It's weird.
Full-time podcasters.
Imagine if we could just do this full time.
I would be dissatisfied with that as an occupation personally, but maybe we'll say that today.
Shout out to our friends at Equity Mates and Rask who do this full time, and I'm sure your lives are very satisfying. No, mate, it's been good. We had a really good week last week. Lots of client meetings, which was good. Quite some people I went to the US with, which was also good.
Oh yeah.
So some business. Talked about our businesses, things that we're doing, well, and could be doing better. So yeah, that's good. What about you, man?
Last week feels like a lifetime ago, to be honest. I'm a bit the same at the moment, kind of running a little bit tight in terms of time, but yeah, going okay. I mean, market's busy, portfolios are doing stuff, and so that's always like time consuming. And then just trying to we've got a bunch of marketing stuff coming up we're doing to kind of close out the year. Which is also time consuming, like preparing slides. And then we had, this time of the month is always busy because we've got month end, quarterly, webinar we did last week, which if you want to go on the Seneca YouTube page at Seneca FS and the latest quarterlies there. Just all that sort of stuff, plus, the regular stuff we're doing. So it is a very busy little time, these sort of 12 weeks rolling into Christmas post holiday. So I'm up in Sydney next week. I'm running around this week. So no, all good though. Really enjoying it at the moment. So like I like being busy.
Markets are good.
And yeah, look, when it's been been a hard 2 years to be an active manager, and when stuff starts to turn, you can kind of feel it in your bones a little bit. And you get a bit excited because you're like, oh, there's money here. So that's kind of where I'm at with it at the moment. Pretty pumped about it, but just need to whenever that also puts the pressure on, because it's like, well, the returns are there to be had. Go and get them. You know what I mean? So you don't always get opportunities like there is now. I think it's not an everyday kind of setup.
Yeah, absolutely. Well, I think today is we'll have a number of things that we want to talk about today around investment, I guess, philosophy, and maybe talking about how we build in those philosophies and communicate it with clients. There's a couple of questions I've had recently around, what is the process of allocating to different investments for clients, and whether or not it's specifically individual, whether or not we have internal guidelines or internal portfolios that we run for everyone. And look, Gavin, you and I do things.
It's convenient that Gavin and I just wrote your internal guidelines, so that's probably a decent place to start.
I would say they're being revised. I'm pretty sure. I think they need some revision anyway. Gav, I'll email Gav later on that when I get a moment to myself.
The brains of the outfit.
I had to run them past the other members of the committee.
Right.
So. But no, I think one thing that's been quite interesting. We've had quite a number of conversations recently about whether or not everyone fits into it, just a bucket. And I think, there's been a lot of tools traditionally that are used within our industry. And I think there's a lot of online tools that are, good as a really starting point, like things like risk profiling, things that help you understand your behaviors around investing. But primarily, as advisors, like I use risk profiling as the very tip of the iceberg. Everything else underneath that is about how we can build an investment that tells a story and is going to achieve something that's real and tangible for those clients. We're going to talk a little bit about that today, I think. And then we might even let you say one or two things within that. So
no, look, I'm actually, it's sort of interesting for me, I suppose, as well, because one, more and more financial planners are my clients as much as anything else. And then two, I probably don't spend, as an advisor for those clients I advise, I don't spend a lot of time trying to define risk profiles for people. I think what we typically do is try and think about, giving clients a really good education around the risks that they're taking to generate the kind of returns they're after. And I think what's more relevant than risk profiles in my experience, and where the sort of the traditional approach is getting an understanding of how your clients behave when those risks eventually eventuate. Because to be fair, risk is important and volatility is important, and understanding how your portfolio is going to behave in various scenarios is important. And what's more important is understanding how you're going to behave as a person, because we can do all of the statistical modeling in the world. I can run 1,000 Monte Carlo simulations, and until we're in that scenario together and we're in the trenches together, if you're going to just wet the bed, sell all your stocks and go to cash, well, I can't help you. It doesn't matter how well I've modeled stuff. So I think understanding these things ahead of time is really good. It's difficult to do, but hopefully you get a few years with people before maybe you do face one of those 20 type events.
I think like it's really easy to have recency bias on a lot of these things. We've had 2 very positive years of markets. 2022 was quite challenging. 2021 was a big recovery year, but it's not that far back that we're considering a time when, for a good month, we basically fielded panic phone calls about what was happening in the world, what was happening, and what the effect of the market was. Like that obviously we're talking about COVID and when the world started going into lockdowns globally, and whether it was Australia, America, Italy, all these places suffered very different versions of that event. But people were concerned about what the effect on markets were, and the best advice at that time, as it always is when those sorts of things happen, is you have an investment strategy, follow it. Don't sell everything, and if you can, buy stuff.
Yeah. Look, it's easy to say and hard to do, and everyone's best mate is Harry Hindsight, and and I think I think it's interesting, but I suppose maybe we'll get stuck in a little bit, Dill. So when you're thinking about I suppose what the money is going to be used for, and defining that with your clients, how do you kind of go about extracting that from them, and what's it like figuring out because I think people can say things are important to them, but what they do and their actions may be mapped to something different sometimes. So how do you get around what we think is important to us and what is actually important to us? And then two, I suppose, how do we link that to money? Because at the end of the day, money from my perspective is just choices, and it's having that gives you options in life. And I think sometimes money having too many options is a bad thing. I think that's why products like Apple are so great. They don't give you more choices. They give you less choices, but they make you more confident in the choices that you're making. And So how are you sort of distilling things for people so that they are really confident in the decisions that they're making?
I think the first thing
Or how
that
are
I
you not
noticed,
making confident? I don't know.
no, the first thing that we notice with almost every single new client that comes in is that the financial understanding of risk is heavily linked to their own personal past experiences. And a lot of the time our clients are coming in, they haven't invested personally themselves. They may have bought property, and they more than likely have, invested through super but been unengaged. And that's sort of the two key assets that people will come with. And they might be good earning, they might have $500,000 in the bank or more, or have inherited money or whatever it might be, but their understanding of making that decision to jump into the market. So we build out, if you think about it, not in the term of investment strategy, but a bottom-up approach where we say, okay, the first thing that we want to do is we want to build out the foundation. We want to lay that concrete slab of your financial life, and we want to understand from you the things that have happened to you throughout your life. I know.
What is the foundation, though? I mean, you say something like that to me, being a emotionally stunted individual that I am. I just go, that's just fugazi financial planner bullshit. What is foundation? What is it? Well, specifically, what is it?
Yeah. So foundation is help understand how you behave with risk, right? So understand the things that you have already experienced in your life, not necessarily financially, but ways in which, we ask clients, the first question I generally ask clients, as a spoiler for anyone that hasn't seen this before, first question I usually ask clients is, tell me about what your parents did when you were growing up and how you've come to be here today. And it's amazing. Most people, the first thing that they'll say to us is, we grew up with money or we grew up without money. And those things, like understanding your behaviors around the differences between that, allow you to understand how someone then saves and builds and those things. So financial foundations are, make sure you've got enough money or protection in place so that if something was to go wrong for you, like you lost your job or you became injured or something like that, that you're protected, that you can continue to live your lifestyle. Make sure that your long-term retirement assets that you may not be thinking about right now, they might be 20 years away from being able to access them. Make sure that you're doing the right things for those, and then come back and think about the now. So helping people think about the things that they may not think about, that's the slab, that's the bit underneath your house that you don't actually walk on and see and do every day, but it's actually probably the most important part of you having a roof over your head.
Yeah.
Because when the wind comes, it doesn't just blow down and you're left on, or when it rains, it doesn't sink. So then what we do, once we've got that foundation of, okay, well, this is your risk, and they've done a risk profile and these sorts of things as well.
That's
perhaps
really a checkbox, isn't it? It's there for us, not there for you.
And we 100% bring that up with people. You do a risk profile, and chances are we're going to have a conversation. We're going to completely override it, because what you actually need, by comparison to what you understand, and that is why you're here for advice. But then we ask the question, right? So assuming everything is hunky-dory, stable, all of those things, we then ask questions like, if we're sitting here in 5 years' time, what has to happen for you to say that's been the best 5 years? And that
I've heard you ask that question a lot. Like, I've heard you say that a lot, and I think it's a beauty, because it not only takes if you ask someone, where do you want to be in 5 years, it's almost like an unachievable goal. It kind of encourages people to think about what would be the very best scenario, rather than thinking what's like a realistically positive scenario. What's a good
I can have as well.
Yeah,
what's something that I can have that I could. Yeah. And so the combination of those things, that's what we use for building out the investment. So lots of people will say, okay, well, we just bought a new house, we've got a $1.5 million mortgage, we'd love to pay that off sooner than we possibly can. Okay, so we work on some sort of debt focused strategy, or building other wealth. We'd love to be able to give some money to our kids when they turn 30. as a deposit or something like that. We want to give them each 200 grand. Okay, so how do we do that over the next 5 to 10 to 20 years, whatever it might be? So putting some tangible outcomes behind that and putting a dollar figure in the future as a planner, like all that we're trying to do is see something that's tangible in the future that we can work towards, right? That we can understand, that we can do. And because that way we can actually plan. And that actually helps us then build what the appropriate investment strategy is and get that confidence level in the investments.
It's interesting. I was talking to someone recently, and having confidence, conviction in what you're doing, I think is probably the most important thing when it comes to investing. So someone asked me, like, who do you talk to about your investment ideas? I was like, no one. Once we've made our idea, we know. Like, we're not guessing anymore, right? I think that the reality is that too many people aren't confident in the decisions that they make, and they're not confident in the investments that they make, and so that they lack conviction. And when you lack conviction, you don't have you don't have confidence in the information that you're getting, the data you're getting. Well, guess what? When things don't go quite exactly to plan, well, you're not going to know whether the right thing to do is to get out of that investment or stay in it or double down. So I
think that's the most common thing that we see with clients who own individual stocks. And the conversation, I mean, you would see this time and time again. You deal with a lot more advised clients than from other advisors as well, where how often have you had a conversation with someone that's like, oh, I bought this stock and it's down 90%, but now I'm just holding on for hope that it recovers. Or
I think any investment is the same, right? But I always say the same thing. It doesn't matter. Every investment you own every day, it's particularly shares, because they are so fungible. And that is, every day you own it is a decision to rebuy it at today's prices, because your alternative is, on a before tax basis, alternative is to sell it, turn it into cash, or to swap it for other shares in another company. So, it's not there's no such thing as holding an investment. All you're doing is mentally agreeing to rebuy it today at today's prices. And I think the more that you get into that mentality, rather than I paid X for it at time 0, and now it's plus 1, and now it's worth Y, and the ones that are green are good and the ones that are red are bad, the quicker you'll get into this game of, instead of having this sort of terminal mindset where it's like, okay, well, you start now and then you get to today, and that's the time period, and you have this perpetual mindset where it's like, I've got a process, I'm just rolling this process forever until I die. All of a sudden you can quickly shift your investment philosophy and thoughts, and you can actually, in my experience, that's when you actually start to make some money.
Well, I mean, that's one of the most challenging things. Probably the most challenging thing is buying and selling. Holding investments is easy, but buying and selling, when you have to make a decision that you like something better than something else.
Correct.
I mean,
why ETFs are growing at the rate that they're growing. It's because it makes you feel good that you can't be wrong.
Yeah,
it's a mental thing. Now, we can do that topic another day, but the point is that it makes you feel good. The reason why they're such amazing products is that they have tapped into, or they have removed the need to feel emotion about your investing, and people still do. But regardless, anyway, I've got sidetracked as per usual. We're making a conscious effort to stay on task today.
We're trying.
Clients come in, they've got views. They've got views on the market. They like this company, they like this stock, they like this fund manager. Market's going up, market's going down. Trump's going to kill the world. Trump's going to kill the world. Like, World War III is going to break out in Azerbaijan. I don't know. You tell me how much, because I can tell you the answer at Seneca. How much credit, value, importance do you place on the client's views of the world, the markets, the companies, the whatever?
So I'll caveat this by saying that there is rare cases where we will have clients that are more sophisticated investors and do like investing for themselves, and they come to us for strategy only. And in that case, we obviously, I
Let them rip. Let them rip.
I love that, right? Because I get to have a more sophisticated conversation about markets, and it's not with you, so it's win-win for me. But
your conversations are not sophisticated. I don't think anyone would sat down with us. Yeah.
And if I want to talk about markets, I'll call Ben or Gav. So
correct. Correct.
But in most cases, their view on a market for me is just it's me understanding what's on their mind and how they're going to behave from a risk point of view. So if a client comes to me and is heavily informed, they read Bloomberg every day, they listen to wonderful podcasts like Wealth and Toil, and I'm sure there's other good ones out there. There's always a level of bias on what you've heard and understand. And if you're not doing this for 50 hours a week, you probably don't have the level of information that the professional does, and your capacity to take a view on a market that's as informed as someone else's is going to be lesser. So client views are important, but for us, they're important to help shape the conversation around what we need to do to educate the client on why we're doing certain things with their investments. And, whilst a client might come to me and say, I think that you should buy gold, or, I think that, whatever it might be, that could be true. And they might be right, I know you don't want to get into it, but clients come to us all the time and say, what are your thoughts on crypto? I have this, I have that. And that's not what we're there for. We're there to say, cool, if you want to achieve this is a way to do that with X amount of confidence, getting this return on an annual basis over and over again. And confidence comes back to that word. So
there are lots of ways to build a house, Dill. I mean, I hate using tradesmen's example because I'm certainly not a tradesman and I can't swing a hammer. But, I've done plenty of labouring, and all what I can say is that there are many ways to build a house. But generally, a tradesman knows one way that works a lot of the time and is really good at doing that particular way. So I think, people should consider people like ourselves as tradesmen. I don't have all the answers. If you just give me an outcome that you want, I can give you a really high probability way of getting there. And what I think, and give you, and look, I don't, there might be other ways. Oh, well, I know for a fact, because I'm a professional, I can tell you there's probably 15 ways I could have told you to solve that problem. This is my preferred way. This is the way that I think works easiest, best. And also, in a nuanced answer, gives you what I call asymmetric upside. So, you're not going to go too far wrong. It's not going to deviate too far south of where you want to be, but you could actually end up a bit further north than where if you play this way. So, everything might, there might, and we're all talking here. We're talking hypothetical probabilities based on the best data I can get my hands on, and based on my experience of dealing with, hundreds of family groups over the journey. So I can't be any better than that. That's all I can offer. But, a lot of people, because they've had a different set of experiences to me, they've had a different set of life, education, blah, blah, blah. They might see other angles to it. And I'm all for hearing in them. I'm all for learning. But at the same time, it's going to be hard for one data point or one source of information to really change my views on things, particularly if it's from someone in a different field, have never really done what I've, you're just not going to be able to marry that. So, I mean, at Seneca, we pay almost zero attention to clients and their views on things. I actually don't care what my clients think of the market. I don't care what you think of that stock. It doesn't really bother me. In the same way, I don't care what anyone else's views on the market are or what they think about stocks either. Like, talk about podcasts and reading and stuff. I don't read anything. I don't read newspapers.
I'm not sure you can read.
I don't listen to podcasts. Like we read company announcements. and then we check everyone else's views through broker reports. Pretty much, that's what we do. So it's not people are like, oh, what do you use for sources? I'm like, yeah, I read a few interesting blogs, but I call that, like Bloomberg is financial entertainment. That's financial entertainment. That's not financial information.
Your sources are, in that sense, your sources are broker reports, and not everyone's getting 50 different broker reports on,
yeah, but we don't use that info to be like, we're going to make a decision on the back of it. What we use that information for is like, okay, well, this is what we know, and we're going to use the broker reports or the bank reports as like, this is what everybody else already knows. And so, on a specific stock, we're trying to find, this is what everyone else knows. This is what we know. Is there a difference? And how do we best exploit that difference to generate the most return?
That's so much more than what everybody else has.
And you can't just click your fingers and do all that. I mean, that's the easy part. The hard part's execution. The hard part's that's the easy bit. Like it's finding the idea. Ideas are worse shit. Like it's execution's everything. And
execution.
It's true. It's true. Like it's like in business. It's like in golf. My golf swing theoretically is amazing, but in execution.
Yeah, execution. Let's not talk about golf. Wow, no, I haven't played golf in months. It's too much work to do, mate. Although the sun has been out, and it's been very tempting.
Very, very nice.
I think that's the good point about that is like I know that you can openly say that you don't care about what your clients think about markets because like the trust there, right? The history's there. But the thing that I think I like that you said most about that is that you can build a very high probability strategy of getting to where you need to go based on what has been asked for. And I think that's the key. And the key is not saying I want to have, this amount of money, this type of compounding return every year guaranteed, because people come and ask for financially things that aren't possible a lot of the time when you're using just numbers. But if you want a real tangible thing that you're working towards, you can build a strategy with multiple different assets to get there. And the other thing was that's important, 15%, like 15 different ways to do something. Does it really, like if you get to where you need to be, does it really matter if someone could have got you there with, maybe an extra 2%?
Yeah,
or 3 years fast. Like as long as you've reached where you need to be.
One thing I'll guarantee, Dill, is when you get to your goal, you'll be able to look backwards, have a chat, have a coffee with your old mate Harry, and be like, I could have done that better. And if you can't do that,
always,
you've probably cooked it, right? So all I'm saying is that there is always a better investment. There's always a better way to do things. In hindsight. Now, what our job is not to worry about the past like everyone does, and not just to look at the highest returns down on the fact sheet that I can find and be like, I'll buy that one. No, our job is to actually deal with the future and the unknown future, and the money is in the uncertainty. So stop trying to look for the returns in certainty, or trying to find certainty to link your mentality to. Start trying to link your mentality to uncertainty, to volatility, to things that can't be explained perfectly and have to have a probability distribution attached to them. Then you can start to think about how the world might work and how you might be able to make $1 out of it.
Absolutely. Well, I mean, just like that's a great segue into the final point that I wanted to make. And asset allocation and how assets are allocated within a portfolio is so critically important to the outcome of returns. Most commonly in Australia, we see that portfolios, in my opinion, are overweight probably the top 20, but at least, the Australian index, which 63% of it or whatever is in the top 23 companies. And simply put, it's not been the place to be of late.
Well, it's fine, right? It's a perfectly reasonable way to invest. If your theory is, okay, well, these 20 companies, they're servicing the Australian growing GDP or inflation plus a bit. And, I'm happy with that. fantastic. Good luck to you. Like, I've got no issues with you doing it. It's not what I'm going to tell you to do. Again, I don't care what other people are doing with their money. I think what's more relevant here is that, can you do better? Well, I can show you 15 ways you could have done better, and I can also show you a probability distribution that I'll get you a better return for the same level of risk. So I think that familiarity and historical boomerisms, I'm just going to bucket it. Like keeping up with the Joneses, chat over the fence at the barbecue type sort of thing, is that bias is quite heavy in Australia. It's quite strong. People feel like, if I'm going to lose money in Wesfarmers, well, I'm okay with that because everyone else will lose money too. And it's just a stupid way to think about your money, because you don't want to lose money at all. You want to make money.
Yeah. I mean, I was going to make the point on that though, that, you know, the ASX 200 accumulation index year to date has, as it today's done, what, 12.83%. No one's building a portfolio with a goal of almost 13% per annum every single year. Like, if you just had, like, it's not been the best. It comes back to what you said before. It's not been the best, right?
Oh, you
like,
can
you could
do
have
it.
yeah, but the thing is, it's not been the best. You still made 13%. Like, that's still a good.
Still, you can do 10, 15s, and 20s consistently. It's doable. The question is, one, do you have the skill to do it? And two, if you do have the skill, do you need to do it? And is it actually relevant? You know, is it, what are you willing to put up to risk to generate those returns? And I think that's where, you know, when you talk about asset allocation, there are parts of the market where you can sustainably generate 15% return on your money. How much exposure do you want to have to that? Because those same parts of the market also have downside risk. And
well, that's it. I mean, but that,
it works both ways. Like, it's not, you can't have your cake and eat it too. You can't have a year when you rip 30 and then not have a year when you're down 40. It just doesn't work. It's not how it goes.
So I think that's the principle there, is that, like, you can, the volatility swings in those markets, it's not actually sustainable to make 15 every year. It doesn't work like that.
I think also, though, you can't say to your advisor, "Oh, I want a diversified portfolio that's appropriate for my stage in life and my situation," and then you're going to have exposure to alts, bonds, shares, global shares, maybe some other, you know, property, infra, whatever, private credit, insert asset class here. And then come to your meeting at the end of the year and be like, look, I only generated an 8.5% return last year, and the S&P 500 did 22. So, like, why are you so bad? It's like, well, did you have 100% of your money invested in US equities last year? It's like, well, no. But then you're like, well, is that what you want me to do this year? Oh, well, no. Well, shut up. Like, it doesn't make any sense. Like, do you know, like, you're not being logical here. What you're doing is Harry hindsighting, saying, I wish the year when equities ripped and did double long-term average returns for the year that I was invested in them. And then when they do half long-term averages at some point in the future and mean revert, I don't want to own them anymore. Like, you're just asking for a job that doesn't exist and that no one can do for you.
Yeah. I mean, like, time travel is, you know, it's going to be something that one day, you know, just changes investments, I guess. But no, I mean, a really good example.
Podcast about that time travel, the physics of time travel. Maybe you could explain that to the audience.
Oh yeah, no worries. Can we do that next week? I just need a bit of time. No, but like, a really good example of that. I think one of the episodes at the start of the year, we talked about China. Like, China was a beaten up market. If you look at the rest of Asia last year, 2023, India ripped, Japan was nearly 40%, like, amazing, right? Now you look at Asia this year, China was like -4
but China's September quarter, China 21% return.
Exactly. Right. But nobody's investing, like, the layman there, and nobody's going, oh, you know what? China looks real juicy. If you just look at what
in August, I just thought, look, all I've got to do is just sell everything I own and buy the Hang Seng, every stock on the Hang Seng. That's all I could, like, all I wanted to do was just buy Hong Kong, obviously US dollar hedge, but also, you know, like, obviously that was obvious, but it's like, man, get a grip. Like,
everything just got 60% more expensive if it was Chinese, though. So,
Dill, you make a really good point. And you know, I spoke to a young guy this week who's been investing in the S&P 500 IVV for his first investment in, you know, in the markets, really. And I started the conversation with him. I said, "Oh, mate, you know, what's his strategy?" He's like, "I want to do core satellite." I was like, "Well, what's your core?" He said, "Oh, I said, well, you know, he goes, I've just got IVV and NASDAQ." I was like, "Okay, have you thought about investing in other parts of the world?" And he goes, "Oh, nah, this has done really well for me. I'm just going to stick with this." I said, "Okay, well, you know, that's great that it's worked for you, but the US might not work for you in the future, or not to that extent that it has recently. Have you thought about that?" And he's like, "Yeah." And then we had the conversation went on, and we got to the premise. We agreed that, you know, he doesn't know anything. There's no reason why he's investing. It's just what's worked for him. It's like, well, okay, that's worked for you, but like, there's a smarter way to do this where you're still going to get good returns, but in the years when the US doesn't outperform, you'll have some of this. And when, you know, not all your eggs in one basket, boring diversification rubbish. And it's just like, hey, that's just such a simple thing you can do that will immunize you against any sort of issue globally. Now, not perfectly. Like, you will still have losses in some years, and you will still wish that you know, with hindsight, that you did this and didn't do that. But at the end of the day, like, it's more sensible. It's the more rational thing to do.
Mm.
Probably won't do it.
You know, no, probably not. But it's the shiny 1 year, 1 month return. Like, if everyone who's listening, don't just go out and buy China now because it's had an amazing quarter, right? Like, that would be silly. You know,
that being said, we're overweight emerging markets, so, you know, we actually think that, yeah, you should be. And I look, I don't know whether,
but don't do it on that basis, right?
No, like, not on that, not on the basis of 20 a good month or a good quarter or whatever. Like, I just think it's the same thing, you know, whether you're looking at, but all of these decisions, whether you like it or not, whether you think you are using low cost index or using active managers, every decision you make in investing is active management. And if you think
every decision you make, or every decision that you're making as a person, whether it be, like, whether it be me, you, Luke, or the person who's going and buying their own stuff, you making a decision to invest, that is an active form of allocating assets. So, whether it be paying for it or doing it yourself, it's still active management.
And as I said to this same young man I was chatting to, I sort of said, look, you know, it's great. You're going to design your own ETF portfolio across the regions. Fantastic. I'm stoked for you. All you've got to do is just figure out what the risk profile is that you're investing in, find an appropriate benchmark, pick one of the, you know, ETF providers who do the multi-asset benchmarks. And I said, just benchmark yourself to that. See if it's worthwhile making all these decisions, or whether you're actually pretty shit at it and you're better off just running a neutral, you know, setting for your risk profile static, and then go and have a beer and enjoy yourself. Like, I just think that people, you need a reference portfolio, and if you don't know what a reference portfolio is, you probably got no business making the decision in the first place.
A really good reference portfolio, though, is, like you say, it's a risk profile adjusted, global, diversified.
Just go and pick a BlackRock, Vanguard, Morningstar, whatever. And look, if you want to you can do one better. I've actually written an article on my website for free. All you got to do is give me your email address so I can spam you with. We actually wrote up is how to invest $1 million. It's a bit of a clickbait article, but what it does go through is it talks about these sort of concepts around reference portfolios and returns, and some of the numbers are about 6 months out of date, which probably needs to go on my to-do list. But the principles stand. So if you go to Seneca and you'll see the pop-up turn up, just type your name and email and you'll get access to that site where that article's hosted, and you can get my whole investment process. It's all there.
Easy,
mate.
And then
free for the punters.
Yeah, it's putting himself out of a job. Can't believe it, mate. Big week last week with the election as well. We did an election podcast. If you haven't,
I knew you were going to talk about this
a couple of weeks ago. Oh, I wasn't going to say anything. I was going to wrap up there, but but no, it was a very interesting week. I think surprised a lot of people. And yeah, I mean, for anyone that hasn't listened to it, there was a good podcast on what we think the implications of some of the new president in Trump will be. So it's worth a listen. I enjoyed doing that episode. He's already come out and said some made some pretty big calls on tariffs and things that he wants to put in on.
I'm shaking. For anyone listening, I'm shaking my head in disgust. But anyway, we'll leave that commentary for another day.
Yeah, I've also had before we go, I've also had a challenge from a listener. We did ask for some challenges, but I did have a challenge come through from a listener. So we have to do an investment podcast. So an investing podcast, but you're not allowed to talk about mining.
Oh, whatever you like. But
yeah, I do.
Actually, can I also do a plug, Dill?
Yeah, absolutely.
On that topic, young Benjamin, the brains of the outfit, has done episode with Rask where he covers off 3 smallish cap technology businesses that we're investing in at the moment. We've invested with at the moment. Really good podcast episode coming out. You won't have to listen to me. I am not on it at all. I was busy. Ben's everyone look it up. It's not out yet, but probably by the time this comes out, it'll probably be out. If not, keep an eye out for it. If you want investment chat, we don't talk about any mining. There's 3 tech ideas coming out.
That's Ben. That's Ben. Ben can do that with his eyes closed.
I mean, look, I think that, I think there's we've got so many good ideas in our portfolio at the moment. And like I said, I've never been this pumped about what we're doing at Seneca. It's absolutely got so much good stock in our pantry at the moment. I'm just like waiting for it to come off so I can start like getting on the soapbox and teeing off, which is my favorite thing to do.
Like a stock stir fry.
Yeah,
mate, let's go. I reckon that's enough. People will stop listening by now. Have a wonderful rest of the week.
Likewise, brother.
I will speak to you soon, and we'll hopefully have another episode for everyone next week.
Appreciate it, mate. Chat soon.
See you, mate. Bye.